In this mini lecture, we're going to introduce and define two very important concepts, those of wealth and of profit. In the business world, and therefore in accounting, these two terms have quite specific meanings. As you'll see in another lecture, wealth and profit align perfectly with, respectively, the balance sheet and income statements. Is this: what do we need to observe and measure? And so what we do with all businesses is to measure the wealth or the net worth of the owners at a point in time. Now there's important terminology there. Wealth or net worth is always measured at a single point in time. And we calculate that quite simply by adding up all of the assets or resources that this business owns and subtracting from that all of the obligations or liabilities. Now the measure of performance, which for us is profit, is a measure which spans a period of time. So the measure of profit or performance is the change in wealth over a nominated period of time. Now that performance might be positive, in which case we call it a profit, or it might be negative, and then we'll refer to it as a loss. So let's just dwell on this for a moment. The measure of wealth, which is one of the most important things that we measure, is a static measure. It happens at a single point in time. The measurement of performance, however, is a measure that occurs over a nominated period of time. So it's a measure that spans probably a year, or maybe you may choose to do it monthly or 6 monthly, but the point here is that it spans a period of time. So we measure both of them in the business world, and we're about to see how we do this. Okay, so what do we know about profit and wealth? Just restating again, wealth is a static measure. It is a stock. It's regarded as a stock of wealth at a particular point in time. So I could say at the 30th of June in 2015, my wealth measures so many assets minus so many obligations or liabilities. I would also then say, in terms of the business world, profit is a measure of change. How much more wealthy did the owners become over a period in time? We can put in front of ourselves the economist's view of what wealth is, and we'll contrast that with the accountant's view, which we measure. But the economist has got away with words, as we know. The economists would say profit is that amount which we could consume and yet still be as well off at the end of the time period as we were at the start of the period. In other words, we can consume it without having any net impact on our wealth. And so you'll see the little diagram there, measured at time period 0 and at time period 1 and at time period 2. But look at the bottom, and the movement from time period 0 to 1 is described as profit. And then again, the movement from time period 1 to 2 is described as profit. Let's now focus on the business's view of profit, because this is what we'll be measuring, this is what we'll be talking about. Profit for a business is also the difference in owner's wealth at the start and end of the period. And it has two components, as we'll see when we start to look at the statements. The first is that it measures our activity over a period. Again, that's that statement, over a period, not a point in time. The activity that it measures is about the core business, the trading and the operating environment, how it trades with its customers, how it purchases and manufactures and uses resources in order to provide goods and services to its customers. So it measures that activity over a period of time. Now, profit in this definition can also include the changes in owner contributions or distributions. So owners may perhaps put in more capital, or perhaps the business distributes some earnings, often referred to as dividends in companies, to those owners over a period of time. When we come to look at how a business is performing its core activities, we'll look at the middle one of those dot points. We'll be looking at the trading activities over a period of time. So let's illustrate what this discussion is about. Now, just a simple little schema here. You can see that we've got an illustration of a balance sheet at time 0 on the left and a balance sheet at time 1 on the right. So at time 0, the balance sheet or the accounting equation shows us assets minus liabilities equals a measure of wealth, which is what we're calling owner's equity. So 200,000 less 60,000 equals 140,000. And balance sheet at time 1 is 250,000 of assets less liabilities 30,000 equals wealth of 220,000. Now what that clearly tells us is that the owners of this business have become more wealthy over the time period which has elapsed from 0 to 1. So we asked the question, well, how did you become more wealthy? And the obvious and generic answer is that, well, we traded at a profit. And so there in the middle is the profit, which is calculated as $80,000. Now what we're seeing here is that having earned a profit, that's to say traded profitably, there is this excess which the economist Hicks would say we haven't consumed. If we haven't consumed it, we're going to have to see it somewhere in either the assets or the liabilities. And so what we see as we become more wealthy is that we may perhaps invest in more assets, or we may pay down some of the debt that we have, or what's more normal is we'll do some combination of both of those. So more assets, less debt, but taken together, meaning that we are more wealthy at the end of the period of time, which in this case spans 0 to 1. Now I'm just going to take a little diversion here and alert all of you to a discussion which is very important when you're considering financial statements, and that's what does the term cost actually mean? Now you and I may think that we know what cost means. However, when we cut to the chase, we'll see that there are numerous different definitions, and probably the most important thing that I can advise you in this discussion about businesses and business performances and accounting reports is always be very clear about which cost is being discussed. Now, I'll tell you that in accounting, if you're not told otherwise, the default is that historic cost will be the cost definition which is used. So let's now quickly look at some of the cost definitions which are available to us.